So why are S&P 500 options priced like nothing is happening this week? Let's ask BayCrest Managing Director David Boole. David, great to have you here on set.
Thank you for having me.
Why this disconnect here?
It's interesting. Nvidia really is the main event of the earnings season. It's the last big company to report. And like you said, options are anticipating an 8% move, which is about in line with how options typically price this type of catalyst for Nvidia. The difference this time around, though, is that it's a $2.3 trillion company. It's at all-time highs. So that's a $185, $200 billion creation or destruction in market cap that the market's expecting to happen tomorrow night. And it's fascinating that the S&P 500 is telling a completely different story. It's seeing almost minimal movement this week, whereas historically, the S&P moves more after Nvidia's earnings report than it does after several big catalysts, such as non-farm payrolls, FOMC, CPI. So there's definitely a disconnect going on here.
How about let's drop that into the context of the NASDAQ? Because, again, we talk all the time appropriately about the leadership of semis to the NASDAQ and to the overall market. I got it. But shouldn't the NASDAQ, what's the NASDAQ doing? Or is the NASDAQ just as, kind of ambivalent or agnostic on this?
It's pricing in a little bit more than the S&P. But right now, the overall market is very, I wrote in a note, it's asleep right now. It's pricing in some of the tightest trading ranges that we're going to see over the last couple of years tomorrow, and then even through the rest of the week, even though this big catalyst is out there. So in NASDAQ as well.
So there are about 80,000 or so call options at strike prices 900 and below, probably to 820. Does that create selling if those options are exercised? Will that put a cap on the stock potentially?
That is the most notable existing option position right now, are those in the money calls. And it's a similar setup that we've seen with other big tech stocks, such as Meta, where if the stock has a subdued, muted reaction, it likely won't come into play. If anything, those options will add a little bit of buying pressure. But if the stock starts to sell off negatively after the earnings print, as those option positions move lower, there could be some additional selling.
And is that because those are effectively hedges for some people that sold upside calls and it gives them that buffer to the downside?
Just looking at the tape, I believe those are long positions for clients, and dealers are short those positions. So as they try to keep themselves hedged, as those options go from far in the money to out of the money, their hedge is to sell stock. So that the main strike price is 880. So if the selling starts and we go below 880, the selling could speed up as we go through that strike. A similar thing happened in Meta, where 465 was that strike price in April. And we sliced right through it. So the selling could essentially speed up. It's just one to keep an eye on.